Welcome back to my channel, Balance Sheets Matter. I got a subscriber request to go over stock General Mills, that's ticker GIS, General Mills Inc. So we're going to do a stock analysis on General Mills. I'm going to go over the fundamentals, a little bit of the technicals, look at the financials, tell you the good and bad, what you need to watch out for, and hopefully what a good price to buy General Mills will be at. So let's get started. First of all, let's take a peek at some of the high level metrics here. We got a P ratio currently right now 15.35 and a forward PE of 14.5. Also, we got a nice dividend yield of 3.38% with a payout ratio of only 0.5. So dividend investors will like this. This is also one of these more defensive stocks. So if you're expecting market turbulence, you want that consistent dividend yield. This is typically one of those stocks to buy. So let's dive into the financials here. Can first see long-term trend for revenue growth is up. There's flat periods, there's up periods, but overall it is quite steady. It's going up, but that's only at 1.7% per year average. So this isn't a big growth stock. This is a very matured defensive company. You buying it, you're going to collect a nice dividend though. You can feel pretty safe in owning it, but we need to look at the financials to see if that's true. One of the first things I like to always look at the return on invested capital and the weighted average cost of capital. So pretty average return on invested capital, pretty consistent around 10%, sometimes a little bit lower, sometimes a little bit higher. But most importantly, they have a very low weighted average cost of capital. So if they want to do acquisitions, expand their company more, they can easily afford to do it. Capital is really cheap for them. They can do it, and then they can get a better return on the other end. Now let's dive right into the income statements. Let's look at the revenue over the years. You can see they were basically growing, but then they started stalling at 2013, 2014, 2015, 2016. They actually started declining a little bit. And it was in 2018 here, they did a very big acquisition for $8 billion, which I'll show you later on the cash flow statement, which helped boost their growth back up. And then these brand companies, that's what you need to realize. These mature brand companies, they always need to be acquiring brands. So the quality of brands they can acquire and what management's doing around that really determines the success of the company, since their older brands do start slowly dying out over time. So they need to be doing good acquisitions and they need to have the free cash flow to afford those acquisitions going forward. So let's look at the gross margins. You can see is around the 35%. Before in the past here a little bit higher, but mostly 35, and we're a little bit lower right now. I don't know if this is quite a trend yet, if we can determine it. With inflationary pressures, this is really common in all stocks right now. So this might just be 1 and 2 years off, basically just for General Mills, just like a lot of others are experiencing. So on the bullish side, we might see this increase back up to the 35% range in the years coming. And we can see on the operating margin here, pretty steady, usually around 15%, sometimes in the high teens. We're a little bit in the lower range. This is reflected from the gross margin. So pretty stable here. And I guess that's also because of their general selling and admin expenses also being relatively stable for the income they make. And you can see they do kind of adjust this over the years. They have brought it down where they did have 3.5 billion in 2013. They've managed to keep that at 3.5 billion. They brought it down, their sales went down, and then they brought it back up. And now the sales are higher with the same general selling and general admin expense. So that's a good sign. They're able to keep cost controls in their selling and general admin. This is one important thing you need to see in these companies going forward, because if this expense balloons out of control, it can really hurt their margins. So onto the interest expense. We have about 382 million in the last year of interest expense, over about $3 billion in operating income. So this is a fair enough, coverage ratio. I usually like about 1 to 10. It's a little bit less than this, but this is sitting pretty good. They're going to be easily able to cover any interest expense, and they will be able to do more acquisitions in the future. You can actually see after their big acquisition in 2018 and 2019, their interest expense ballooned up to over $500 million, but they did help aggressively pay down that debt, bringing their average interest expense back in line. Now, the one thing I want to note here is in the other income expense, this is usually from writing off goodwill or doing sales of the businesses. They did have a boost here in income. This is not necessarily all these cash they made. These are just sometimes fair value adjustments, depending how it is. And that was 477 million. So the income we're seeing here and at the net income, this is kind of artificially boosted, or their core operations are artificially boosted to be a little bit higher if you just look at the bottom line from this income here. So we need to factor this in, that right now the income we're seeing, the PE ratio may be, the income may be a little bit high, and the PE ratio may be looking a little low because of this. Because typically companies who acquire other companies are going to usually be typically having just net write-offs as the goodwill, their acquisitions. It's not always 100% efficient. They have to write it down a little bit, and this is typically where those expenses show up. So we can see down their net income. It was back in 2008, 1.3 billion. It's been slowly ticking up over time. Again, we do have a little bit of fluctuation here and there. And when there is the fluctuation down, the stock price is low, that can sometimes typically a good time to buy. And we've come down a little bit from the peak in 2022 of 2.7 billion to 2.6 billion. But remember, there's 477 million of basically that wasn't from the operating income. So this is actually lower in the real fact here. And our EPS, it's been increasing up nicely, over $4 per share right now. And the net margin, we're at 12.91%. It kind of looks like being increasing, but just as I keep saying over and over and over again, this is probably artificially a little high from that other income they were showing on their income statement. So that's the big thing to look at. And now let's look at the shares outstanding. They have been doing a good job at slowly buying back their shares, reducing that share count. Around this time here, they did pause for a little bit. It did increase a little bit because they were focusing more on basically paying down that debt, and they did issue some new shares to do that acquisition. But now they've started buying it back again. It's a good trend to be going for. So let's take a look at their balance sheet, see how they're doing in those regards there. Basically sitting total current assets, almost 5.2 billion. What are their total current liabilities? 7.5. Not a great current ratio. They're running their balance sheet a little tight here, but for these big companies like this, the current ratio is really not always the biggest deal. So let's look at their overall basically assets. They have just over 31 billion, close to 31 billion, 500 million. But as I said, they do a lot of acquisitions. 14.5 billion of this is goodwill. So this is not real tangible equity on the balance sheet, and this might be written off in the future. And that's one of the risks you have to look at with General Mills going forward. So we go down, total liabilities are 20 billion. You can see there just under 10 billion in long-term debt. When they did do this big acquisition, it was 12 billion. They did pay it down, and they've decided to kind of get it down to this. Maybe they're going to pay it down a little bit more. Maybe they won't. That's going to be at management's discretion. And that basically leaves us about 10 billion in total equity. But remember, there was almost 15 billion. I think it was 14.5 of goodwill. So in real tangible equity, they're actually at negative $4 billion. So I don't consider this the greatest balance sheet. A lot of companies that are more mature, they run their balance sheets like this. I would prefer at least they get it more to a flat zero, pay down some more of that debt, but we do have to take that in consideration when doing evaluation, that there is basically total tangible real equity of negative $4 billion. So that will garner a lower value for the company compared to a company that has positive tangible equity. So let's look at the cash flow, see what they've been doing with their money. You can see cash flow from operations, obviously positive, obviously looking good. And then they reinvest a little back into their company. Small amounts of purchase of plant, property, and equipment, pretty stable throughout the years, fluctuates a little bit, not too big of a deal, but really where a lot of the money goes is these different acquisitions. Like I was saying, in 2018, they did a big acquisition for $8 billion. Here you have another acquisition for 1.2 and some back here. So it really depends on the quality of these acquisitions if they're going to be able to keep growing that top revenue line. So they have to be doing good acquisitions. It looks like they're not jumping in when they don't have to, and they're trying to do good ones. And the very fact that a lot of goodwill hasn't been written down yet probably means there has been overall good acquisitions. And then also, they sometimes sell some of these businesses that they acquire, and that's probably why when we see the sale of business here for 633 million, and they're showing another other operating income of 477 million, this might be related to that. So when I am seeing positive numbers when they are selling their businesses from other operating income and not a lot of write-downs on goodwill, which let's just go back up to those lines there to look at again. Right here, you can see a little bit of write-downs, but we also got some positives. This probably means they've been doing good acquisitions over the years. So General Mills gets an A+ for that. I would like, again, for them to have a little bit of better balance sheet. And you can see from when we look at the issuance of stock, they're not issuing stock unless they're doing an acquisition for that one big acquisition. They are buying back a lot of stock. They have started again, but you can see that time when they were paying down the debt, which we can see just on the line just below here, their basically net issuance of debt was negative $1 billion from cash flow, 900 million. So they were taking these years, a few years, rather than buying back stock, they're paying down their debt. I would preferably like to see a little bit more paying down of the debt. Their debt is pretty cheap, but I would like to see that just to get their balance sheet a little bit closer to flat in the total equity there. But when they aren't doing that, they're starting to purchase shares, return capital to shareholders, which is pretty good. And they're also paying out those nice consistent dividends every year as well. And you can see free cash flow positive, no off years, not even during the great financial crisis of 2008, 2009. This is why this is a defensive stock. So basically when shit hits the fan, the economy is not doing well, General Mills is still making money, they're still paying those dividends, and that's one of the reasons investors like to get into it when they think there's turbulent markets coming up. So let's now jump into the interactive chart here, see what the relative valuation is, and kind of get an idea what might be a good value to pay for General Mills. So here's the stock chart here. First thing I like to look at is the price to sales ratio, which I frequently do. And let's just do a little bit shorter time frame since we don't need to see way back then. It's kind of irrelevant. And you can see, the price to sales ratio, it's not all the way down kind of in the pits yet. It is a little bit higher. We do need to also look at the net margin to see what we should be looking at for a relative value for the price to sales ratio. So I'm actually going to stretch this out a little bit more to the 30-year. And we can see it almost looks like there's a general trend up. But again, I think some of these years were 1 year offs. So I think it's most likely that we're going to be seeing more of a flat, stable net margin. So I think for the price to sales, we should be comparing back to this history here from 2000 going forward to find a good relative valuation, since I don't actually think they are going to be consistently growing their net margin. I think that may be reducing in the next few years, because also the gross margin, we want to look at that. You're not going to be increasing your net margin if your gross margin is not increasing as well typically. So let's just look at that on the chart. Just take the price to sales off, look at a little bit shorter time frame, and you can see that gross margin has been slowly declining over time, relatively flat back here. It's dipped a little bit again on the bullish side. It may come back up. So let's take that away, go to the price to sales ratio, and you can see this is kind of in the middle of where the value is. Maybe it's saying fair value. I would like to purchase when the stock's a little bit lower, maybe at least down here when it's getting into 1.7 price to sales. If there's really something going on in the economy, maybe even lower, because historically it has got as low as 1.38, and in the great financial crisis 1.16. And let's compare that to the price here, and you can see again there's really strong correlation with the stock price and the price to sales ratio. This is why I like using these ratios and looking at the fundamentals, and if they match up, it's a good way we can find an attractive relative value. So I'll be waiting for the stock to drop a little bit, and if it does, probably looking at a good time to buy it. Let's also look at the dividend yield here. And you can see there's a decent spike on the dividend yield going, but compared to this time back here, the dividend yield got a lot higher. I would really like to buy General Mills when it's yielding, closer to a 5% dividend than compared to a 3.34%. So now I'm going to jump into the stock chart, look at some more technical factors, figure out where's a good place to potentially buy it. So I basically have created this little pitchfork channel here. I think it reflects the overall fundamentals of the company fairly well, the trend it's going. It's fairly in line with the moving averages as well. This is a monthly chart, and you can see the times you want to buy when it gets to this lower trend here is at the red 100-month moving average, or the yellow 150-month moving average, or even the 200-month moving average. So I think naturally, pretty intuitively, you look at this, you would want to probably be buying General Mills, or at least I would, when it gets to the mid 50s. Maybe it drops to low 50s if some shit really hits the fan, but I think there's interest anywhere in the basically mid 50s, maybe even the mid high 50s. But I would be waiting on this stock right now. I do have it on my watch list now, and if it does get into these 50 ranges, I have hundreds of stocks on my watch list. I will be buying some General Mills. So I hope you like this analysis. If you liked it, remember to like, share, and subscribe. Subscribe to my channel, and if you do want to see any other stock analysis, you can leave a comment below, ask me to look at a stock, and I'll probably check it out.